A terrifying economic crisis is gripping Germany, sending shockwaves across Europe. What does this mean for the global economy and, more importantly, the U.S.? Stay tuned. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, Germany's economy is unraveling at an alarming pace, which could bring catastrophic consequences across Europe. But think the U.S. is safe from Germany's economic crisis? Well, cracks in the U.S. services sector now suggest we're not as resilient as many hoped. Plus, we have a sponsor of today's show. I'd like to welcome BTCS to the show. And BTCS is the only public company exclusively focused on the Ethereum infrastructure. They're not just building blocks, they're building the future of blockchain. With an upside potential of up to 45% as it just entered a swing trade, you may benefit from anticipated growth driven by innovative product launches and the evolving cryptocurrency market. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, let's head over to S&P Global, because the real key here, when we talk about the global economy, when we talk about economic crises, it all comes back to one thing, and that is jobs. And right now in Germany, they're going away. As we look to the Services Purchasing Managers Index, which indicates business activity ticks up in December, but not for workers. And this is all on the back of price pressures, and that's not a good sign either. We now see the business activity index enter an expansion at 51.2. This is after seeing a contraction back in November. But let's take a look at the details, because the upturn in business activity was on fragile foundations. And this is a problem we've noted for Germany, that their manufacturing sector is in an outright depression. We're seeing their automotive base completely collapse. And we've mentioned that where manufacturing goes, services follows. Yet many people believe right now it's the services sector that's going to drive demand and pull the global economy out of this slump. But what a lot of people don't realize, that services companies, they get about 70% of their business from the manufacturing sector. So when manufacturers are hurting, well, it's only a matter of time before we see that in the services sector, as we're now seeing in Germany, with the latest data indicating that underlying demand for services remains sluggish. December saw a fourth successive monthly reduction in inflows of new business across the sector, linked to customer uncertainty, a lack of public sector tender opportunities, and here's a big one: weakness in manufacturing. There was also a sustained downturn in demand from abroad. Meanwhile, consumer services was one area that did see a healthy intake of new work. But once again, we see downturns in manufacturing lead to a decrease in new orders, and that means backlogs get worked through and labor starts to go. And that's exactly what we're seeing in Germany. With total new business continuing to fall, activity levels across the services sector were supported to some extent by work on backlogs. Number of projects and orders outstanding dropped markedly in December, and is slightly quicker than the month before. So what we're seeing here is that normally workers would focus on new orders, but there's such a lack of them that they're managing to work through the backlogs at an increasingly faster pace. The problem here is once the backlogs are gone, well, the need for all this extra labor is going to go with it. And as expected, employment fell across Germany's service economy for the 6th month in a row in December. That said, as has been the case throughout most of the sequence, the extent to which staffing levels decreased was only modest. Where workforces were scaled back, firms commented on a lack of new projects, targeted productivity gains, and cost-saving efforts. And productivity gains are huge, because what it means is that workers are becoming more productive. They're able to handle the workflow at a faster pace. And when that happens, you don't need as many workers. But something else we think is surging along with Germany's productivity, that's the stock for our sponsor for today's show, BTS Inc. You can find them on the NASDAQ, under symbol BTCS. And let's look back on this recent chart. You can see when they entered a swing trade, which is a close over a rising 9-day moving average. You see that in orange, and look what happened. The stock took off. What we're seeing now is the initial stage of a swing trade. We got a close over a rising 9-day moving average, setting up a move right back into a prior level of resistance, which would make a potential 45% trade. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's take a look at productivity gains, because these are absolutely critical. And we're going to see this in the US because it impacts the economy in two different ways. The first is inflation, and the second one, as we're seeing in Germany, is labor. And in the U.S., what do we continue to hear from the political elites, such as the Federal Reserve, is that the labor market is stable, there's enough demand, but yet what we're seeing in the U.S. manufacturing sector is a continued slowdown. It's eventually going to hit the service sector, just like we're seeing in Germany, and this is a dangerous path. Because when we take a look at productivity, this means the output per hour for a worker is increasing. And when that happens, an employer doesn't need as many workers. And next thing you know, you see inflation come down. You see a very strong link between the two, that when productivity rises, inflation comes down. And it has everything to do with the cost of labor, because the biggest expense for a business is workers. And so if you don't need as many workers, well, that means you don't have to keep raising your prices and inflation starts to come down. But there's also a knock-on effect that happens in the economy. As fewer people is working, well, it means there's less demand because there's less money being spent in the economy. And that's exactly what we're seeing here in the US. And we're just seeing in Germany it moving at a much faster pace because their economy is in a downturn, is farther ahead than we are. As we look at productivity in blue against continued unemployment claims in red, and what do we see? The periods of rising productivity match periods of rising unemployment claims. And you can see that in these cases, when people go on unemployment, there aren't a lot of opportunities, so they get stuck there because employers are saying we don't have enough work, that we need more employees. The ones we have can do the work. And that means we see sustained rises in unemployment, just like we're seeing in Germany. So when we look at where we're at currently, it becomes very clear we saw a big rise in productivity. And what happened? It came with a matching increase in continued unemployment claims. And one thing we saw in the data is that people are getting stuck on unemployment for 3 months or more. So what that's telling us, that there isn't enough demand in the economy. There aren't enough new jobs being created, and that the existing workforce can handle all of the new orders and still handle the backlogs. And this is a huge problem because as people get stuck on unemployment for longer and longer, their spending power decreases. It backfeeds into the economy and leads to more people losing their jobs. And that's exactly what we're facing in Germany. It's this spreading all across Europe. It's going to hit Asia as well. December saw a steep rise in business costs in the services sector, with surveyed firms often citing the influence of growing wage bills. So what we're seeing is services companies are forced to pass on higher prices due to higher wages. And when you see this linked with rising unemployment claims, this is a major problem, because what it says is an economy is squarely going into a recession. There's absolutely no question about the path it's headed. And indeed, the cost pressures led services firms to be more aggressive in their own price setting at the end of the first quarter. Average prices charged rose to the greatest extent for 8 months, and at a rate that far exceeded the long-run trend seen prior to the pandemic. So this is an issue for those who aren't working, who don't have as much money. Well, it means their money is not going as far. Demand is going to further decline, and eventually this inflation, as Germany's seen, is going to turn into massive amounts of disinflation, potentially even deflation, sending their economy right into recession. It's going to spread all across the world. And the U.S. economy, as you're going to see, is not immune to this, because when we look at real retail sales, let's turn to U.S. data here in blue against the consumer price index in red. And what we're looking for is retail sales growth slowing amid higher consumer prices. And now we've got continued unemployment claims in green. And when you see slowing retail sales against higher inflation, at the same time you're seeing rising continued claims, you'll notice you hit a recession each and every time. So it's a foregone conclusion that Germany's economy is going to go into recession, most likely a depression. Now, the U.S. economy isn't there yet, but if we see a downturn in spending going into 2025, watch out, because that means unemployment claims are headed higher, and all that on the back of rising inflation being a big problem for U.S. consumers and consumers all around the world. And we can see it spreading all across the Eurozone, as we now see the Eurozone economy contracts marginally in the final month of 2024. So much for the soft landing. Employment across the single currency market subsequently fell in December, with firms reducing their workforce capacity. In fact, the rate of job shedding was the joint sharpest in 4 years, matching that seen back in October. Job shedding was once again exclusively driven by the manufacturing sector, as fractional and slower uptick in headcount as services failed to counteract factory retrenchment. And despite lower staffing numbers, Eurozone companies were able to reduce their volumes of work in hand, i.e. orders received but awaiting completion during December. Backlog work has fallen in every month since April of 2023, almost 2 years running. So what we're seeing here, as high-wage manufacturing employees lose their job, their spending power is going to decrease. It's going to flow right through the services sector, and it's going to get worse, because what's happening in the manufacturing sector is they're running out of backlogs. Here in the U.S., We've been going at it for over 2 years. It's a matter of time before you see all of these backlogs gone, and next thing you know, there's not enough work. You're going to see a mass amount of unemployment all across every industrial country. And let's turn to the U.S. data, because what we see is U.S. factory orders tumbled by 0.4% in November. This was from an upwardly revised 0.5% change in October, dragging new orders down minus 1.9% year over year, the worst since June. And you can see the U.S. economy is on the same track as Germany's economy. We're just well behind, and this is pretty normal. When we see the world going into recession, well, the last person is going to be the world's largest importer. But we can see now that final durable goods orders print tumble 1.2% month over month. That's massive, as the headline month over month drop dragged the year over year rate of change in durable goods orders down a whopping minus 6.4%. Now, this is a non-seasonally adjusted, so what we can see is a huge drop in new orders. The government trying to smooth that number up to make everyone think it's not as bad. But let's take a look at what happens to the labor market, because that's what this is all about. That's what's going on in Germany. It's going on in the Eurozone. It's an issue with labor. And when manufacturers' new orders shown in blue go into contraction, well, it means you need a whole lot less of labor. And sure enough, we see continued unemployment claims in red rising. And that's exactly what's happening here at current time. We see new order growth contracting, and everyone's hoping that the U.S. labor market is going to turn around. But based on the data, that is highly unlikely to happen. And when we turn to what's going on in the services sector, we start to see some cracks, despite the fact that the headline data looks pretty good, as they note that a renewed rise in employment as output growth strengthens. We saw a greater willingness among customers to spend following the presidential election. There's two reasons why. One, companies were discounting, so that's a big factor. The second one is the tariffs, as many people were looking to front run them out of fears that in 2025 prices were going to go up substantially. This is a risk because this means spending could drop in the first quarter. And while workloads were rising and companies increased employment for the first time in 5 months, it may not hold. The strength of the rise in overall new business meant that backlogs of work accumulated again in December, the third time in the past 4 months, which has been the case. And this is good news for U.S. workers. Backlogs give you some sense of job security, but employers weren't that confident. And efforts to limit the buildup in backlogs of work and respond to the strong growth of new orders led service providers to take on extra staff at the end of 2024. However, a rise in staffing levels ended a 4-month sequence of job cuts, but here's the key part. It was only modest, so you can see services employers weren't that confident. And there were further signs of cost pressure moderating in December as the pace of inflation eased for the third consecutive month to the weakest since last February. Input prices still increased markedly, however, and at a pace that was faster than the pre-pandemic average, suggesting inflation could turn higher in the near term. And this has been a big problem as we see people stuck on unemployment. We see the economy slowing. What it's telling us is that demand is going to plunge. In response to higher input prices, companies increased their own selling prices, but notably no mention of passing this along to the employees. The rate of inflation remained modest, despite quickening slightly from that seen in November. And when we take a look, this is something we saw in the data. We mentioned that when the producer price index, as we look in red for final demand, was continuing its upward trend, I said back then it could lead to a rise in consumer prices, and that's a huge problem because wage growth isn't following through, and particularly for those who are on unemployment. As we look at total income growth, now shown in red, which is average hourly earnings multiplied by average weekly hours of production and non-supervisory employees, and if we see a downturn in hours worked, this is going to be dangerous because it means total incomes are going to fall. And I think this is a likely outcome because, again, there was a lot of spending going into the end of the year based on discounts and the fear of tariffs. If we see a drop off in the first quarter, which we normally do as U.S. consumers turn from spending into paying down their holiday debt, well, it could mean that we're going to see workers unable to keep up even more. What these rising prices means less demand and ultimately less jobs. But let's turn to China, and this is a story we've been focusing on as China pushes back against yuan weakness after last week's slide. The PBOC on Friday said it will strengthen the management of currency trading and crack down on behavior that disrupts the market. The central bank will also aim to prevent the building of one-sided bets and any overshoot in the exchange rate, meaning they think it's all about speculators, but then wait till you see what the news reported. State-owned banks were seen selling dollars on the onshore market to meet demand for the dollar on Monday. And what does this tell you, my friends? Is we're facing a global dollar shortage, and this is a problem because it's sending the dollar higher. Could spark an all-out global currency crisis. At the same time, we're seeing Germany's economy head into depression, and the U.S. economy continued to slow down. But something we think is on the rise is a stock for our sponsor for today's show, BTCS. You can find them on the NASDAQ, under symbol BTCS, and we think their stock is poised to swing up as much as 45%. Let's take a look at what the company's doing. We'll review those charts again because they're exploring the potential of blockchain technology, and they're driving scalable growth through a diverse range of business lines, leveraging and built on top of our core and proven blockchain infrastructure operations. Our strategy focuses on driving scalable growth of our staking as a service and Ethereum block building operations. Leveraging our expanding blockchain infrastructure and industry experience, we're able to operate and develop cutting-edge solutions for rapidly advancing blockchain technologies. They're a high-growth and scalable business model. They've got a dedicated team of deep industry and capital markets experience. They got low public float. They're debt-free, and they have 32% inside ownership. And their core infrastructure is focused on proof of stake as they secure disruptive next-generation proof of stake blockchains that power DeFi, NFT, and metaverse ecosystems. They operate and maintain validator nodes on a 24/7 basis across various networks. They earn revenue by staking their crypto assets, securing blockchain networks, and participating in network consensus mechanisms by validating transactions. And ChainCube provides a simple way for crypto holders to access otherwise hard-to-obtain blockchain data, similar to Bloomberg for financial research or Westlaw for legal research. ChainCube utilizes cutting-edge generative AI and advanced customized search functionalities and provides efficient querying of indexed on-chain data. ChainCube is currently available in beta with support for Cosmos Atom blockchain network. Additional blockchain network integrations are planned for the future based on market opportunity. And speaking of opportunity, they're highly focused on Ethereum block building as the market presents a critical component of validator reward distribution. The current builder market is dominated by a small number of network participants, and this is setting up a market that is poised for growth primarily through price appreciation and increasing transactions on the network. And what is Builder Plus? It's their newly developed Ethereum block builder, which utilizes advanced algorithms to meticulously construct optimized blocks for on-chain validation designed to maximize revenue. It monitors the Ethereum transaction queue for pending transactions and reorders them strategically to create an optimized block that contains transactions with the highest fees. And builders pay a fee to purchase rights to block space from a validator and earn the transaction fees associated with the transactions in the selected block. And they're also focused on staking as a service, which is a big market opportunity that grows with blockchain network adoption. We anticipate the market participant structure for the subset of blockchains depicted below to be representative of a much larger POS market, and something we think could be much larger. That is your trading account. But let's take a look at what we see as a swing trade setup here. And we go back to October of last year where we see the beginning stages of a swing trade, which is a close over a rising 9-day moving average. You can see that in orange, and it took off as a stock rally, broke through overhead resistance before sellers came in, and now we're seeing a setup again. A matter of days ago, we see a close over a rising 9-day moving average, and what this is doing is setting up a potential 45% move right back up into that resistance zone. Let's take a look, because when we turn on the volume profiling, we get a very clear picture of where overhead resistance is, and this is setting up a potential upside move of 45%. And again, you can find BTCS on the NASDAQ, under symbol BTCS. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.